Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, December the 29th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We have had some economic data here in the United States, not so much across the pond, but here in the United States, we had unemployment claims come in at 265,000, lower than the expected 277,000. Some might believe that that is a good thing. It just is people not really looking for unemployment right now. But anyway, it doesn't necessarily mean they're being hired. On to wholesale, premium wholesale inventories came in at 0.9%, was expected to be 0.1%. So that increased more than expected. That, to me, I usually don't look at these wholesale inventory numbers very much, but being a holiday season, that's a little bit of a red flag to me because I would have expected to see some more drawdown in inventories heading into the new year. People want to get rid of their inventory so that they don't have that cost of carry into the new year. That isn't being reflected in this number, so that could lead me to believe that they ramped up production getting into the holiday season and just didn't move inventory, which would lead me to believe that maybe retail sales is not doing as well as they would have expected. Then we had natural gas storage come in at a drawdown of 237 billion cubic feet, was expected to be a drawdown of 219 billion cubic feet. So a little bit more of a drawdown than was expected there, but we have seen a lot of cold temperatures across the Midwest and in the northern states. So even down south towards New Mexico, Arizona has seen unseasonably cold weather, if you will. And then on to crude oil inventories. We had a build of 0.6 million barrels, was expected to be a drawdown of 1.3 million barrels. Again, expecting holiday traffic, things of that nature. We should have seen more of a drawdown there, but crude oil inventory is surprising to the upside on a build. That brings us to the crude oil chart here, which is /CL. Crude oil just slightly in negative territory by 19 cents, 20 cents right now, but back below that $54 a barrel area. It was trading up and above there before that data point came out. It was actually trading right on the highs as that data was released, and the market has since come off from there. We have come off of that low a little bit right after that initial sell-off. That could be a little bit of short covering going on, but below that $54 a barrel area, and I talked about that resistance area being around 54.24, so that's kind of a line in the sand, if you will. Then on to gold futures. Gold futures surprising the upside, up about $17, $18 today on the highs as we speak for the most part. Looks like the bears have lost control of this as we've gotten above that 9-day moving average solidly now and looking to go up and test that 50-day moving average. So the downward trend here is at least broken in the near term. So I would expect it to want to come up and try and test this 1175 area, which is a nice area of which is going to act as the next resistance area, I should say, to be tested. So could expect to see that relatively soon. I think it's going to go up there and try and hit that. On to the bonds. Bonds waning a little bit, almost unchanged for the most part. But this doji, even though we've gotten above that 9-day moving average, it tested it several times as we were talking about this on the daily market commentaries yesterday, blasted above and settled above there. But today's doji is not looking too good. could easily start to see it slip tomorrow. And as these start to expand a little bit wider, we could see a little bit of movement to the downside in the bonds in the near future anyway. But the reason why bonds are down is because yesterday we had, or up, I should say. Yesterday we had a big down move, especially late in the day. I talked about it on the market commentary, how we saw the big move off the economic data yesterday with the pending home sales. We saw a blast down again in the late afternoon as a lot of these hedge funds were getting out. That's atypical of big money moving around the markets. We see it early in the morning and then late in the day, and in the middle there's just not a whole lot of things going on. It's mostly retail traders. I talked about this week being a down week as we start to see some of these guys cover and jigger, if you will, their portfolios to rebalance them. And I think that's what we're going to be seeing going on. Yesterday, the Dow Jones did settle below that 9-day moving average, which was acting as support on the way up. But now that we're below that, it's going to be really interesting to see how today reacts and whether or not the bears take control of that market and keep it below that 9-day moving average, because it was just a smidge under yesterday. Then on to the NASDAQ down about 16 points, again continuing to the downside. We are pretty much on the lows of the day in the NASDAQ. It looks like we are on the lows actually, and pulling away from that historical 5,000 mark. I've talked about this. I think we're going to see more of a correction before it actually takes off there. There's just too much euphoria around those two numbers between the Dow 20,000, the NASDAQ 5,000. Those historical marks are not looking very good. Also, the yesterday's settlement below this value area high leads one to believe that we could easily see the correction come down here to around 4,800, which is the point of control. Anytime the market goes up, tests above that, settles back below it, it is usually an indication that the market is going to want to trend down to the point of control. Then on to the E-mini S&P. E-mini S&P is solidly above that value area high, but again, yesterday's late day sell-off really pushed the market down, and we are pretty close to the lows of the day as we speak it as well. Overall markets, equities down, gold pushing up, all of these things, bonds rallying. A lot of these things are starting to look like people are starting to maybe move some money out. Some smart money is moving out of the equities and into the safe haven of things like gold and other commodities along those lines. This is the E-mini S&Ps, very close to the lows of the day. For the most part, overnight trade pretty, lackluster at best. Right before we started today's overnight session was when we printed those lows, so we could easily see this market want to come in there and print those lows during the day session. That has pretty much always been the case. The market does not like it when the overnight session has printed a high or a low. It has a tendency to want to be the big dog, if you will, and have those prints within the day session of open market trading. On to a few things that I've done. I talked about NVDA yesterday, or the day before, maybe it was yesterday, that it got downgraded. Some funds were talking about how they thought NVIDIA was going to go down towards this 90 area. I'm still in the camp that these are one of the few markets that I'm actually bullish. I think that they're going to surprise to the upside with holiday sales. I think a lot of people are starting to switch to these PCs, back to the PC. At one point in time we were saying the PC is dead because everybody was going to these laptops and the smartphones were going to take over all of this. But the more infrastructure around these PCs, they're just really robust for a lot of these games that are coming out. The tablets can't keep up with it, and you can do a lot more with the home PC. They're just a lot more robust in nature for what these new video games are pulling. So you can't really do it on a laptop necessarily unless you're going to be spending, $5,000 or more, whereas you could get a nice PC for under $1,000 and it will perform probably better than what that laptop will. So I think a lot of these kids are starting to venture back towards that. Anyway, with NVIDIA, it is down on the day, but it's had a big move. I decided to put in a strangle, which is very similar to the iron condor, but it's not a defined risk strategy because we've gotten this expansion in volatility due to that downgrade yesterday. So we saw that expansion really happen yesterday. I'm looking for a little bit of that contraction and volatility, so that's why I went into that strangle. And NVIDIA, I went in and did the January and sold the 93 puts and the 120 calls to create that strangle. That's right in line with what I talk about in these webinars. The rules right around it, perfectly set up with NVIDIA, and I collected $2.22 for that strategy. So what I'm looking for is it to stay just below that 52-week high, or it's probably a historical high for NVIDIA. I mean, it's had such a massive rally. And then just above this volume node right here with those 93s. So my break even is right there at that volume node because I've collected such a big credit. I actually have it all the way to 91 is going to be right around where my break even is. So that fits in line with all of those rules that I talk about in those daily market commentaries. Then on to the other trade that I did, FXE. Decided the same thing. FXE has pretty high implied volatility, but it looks like it might be wanting to come off a little bit. It's not really gone anywhere. So I did another strangle around FXE and went into the February this time and did the 98 puts and the 106 calls and collected 72 cents for that. I did that one a little bit smaller. Not a big fan of this contract, but and I don't really have a directionality assumption on it, but I did this one a little bit smaller. So and I wasn't able to collect a real chunky credit like I was with NVIDIA. So just a little bit smaller credit. I'm going to try and take advantage of a little bit of volatility crush if we can get some of that. So that's about all I got for you guys today. Tomorrow's webinar is going to be on the covered calls, so that's a really good one, especially when markets are at all-time highs. If we start seeing a bit of a correction, that will help lower your basis on these stocks that we have in our portfolio, or ETFs if you have some of those. We'll be able to lower our basis, lower our risk, and I'll show you the probabilities around that, how you can be successful with using a covered call strategy and increase your yield over time. All right, that's all I got for you guys today. And if you can't take that, take it easy.